$200 billion typed into a single post. And suddenly, the American housing market is supposed to breathe again. On Thursday, President Donald Trump announced he had ordered my representatives to buy $200 billion in mortgage bonds. The goal was simple: lower mortgage rates, lower monthly payments, make homes affordable again. It sounds bold, decisive, almost reassuring. Trump argues the money is already there. Fannie Mae and Freddie Mac, the government's mortgage giants, now hold enormous cash reserves. In his telling, this is unused power waiting to be deployed. But here is the question you should be asking. Not whether mortgage rates are too high, not whether Americans are hurting, the real question is this: can a political order bend a financial system that has resisted every shortcut before? Stay with me, because what looks like a rescue may expose something much deeper about how housing, power, and markets actually work. And to understand that, we need to be clear about the problem itself. At its core, the housing problem in America is not mysterious. Homes are expensive, mortgage rates are high, and millions of families are locked out of ownership. Trump's move targets the most visible pressure point: interest rates. If mortgage bonds are bought in massive quantities, borrowing should become cheaper. That is the theory. We have seen this before. During the pandemic, the Federal Reserve purchased vast amounts of mortgage-backed securities. Rates fell. Monthly payments dropped. Homeownership surged. But the present moment is different. Mortgage rates have stayed elevated even after rate cuts. Sales remain frozen. Inventory is scarce. Why? Because millions of Americans are sitting on ultra-low pandemic mortgages and refuse to move. Supply has dried up. According to research cited in this debate, the country is short roughly 4 million homes. So the issue is no longer just the price of money. It is the structure of the market itself. Lowering rates may help at the edges, but it does not create homes out of thin air. And that tension sets the stage for what comes next. To see why, we have to look backward. To understand why this moment is so fraught, you have to look at how housing finance evolved, not as a political issue, but as a system. For decades, Fannie Mae and Freddie Mac sat quietly at the center of American home ownership. They did not lend directly to buyers. They bought mortgages, bundled them into securities, and fed liquidity into the system. Their role was stability, not drama. After the financial crisis, that role hardened. Risk was feared. Supply tightened. Construction lagged behind population growth year after year. Then came the pandemic. The Federal Reserve flooded markets with support. Mortgage bonds were bought in enormous volumes. Rates collapsed. Demand exploded. But supply never caught up. Builders faced labor shortages, zoning limits, and rising costs. Millions of homeowners locked in cheap mortgages and stopped moving. The market froze in place. That is the system Trump is now pushing against. Not a single lever, not a single institution, but a chain of incentives that reinforce each other. When you pull one link, pressure builds elsewhere. And that is why this announcement matters, because it collides with the system at its weakest point, which brings us to the first real shock. The shock is not the size of the number. $200 billion sounds enormous. But America has seen numbers like this before. The shock is who is doing the buying, and how traditionally when mortgage bonds are purchased at scale, it is the Federal Reserve acting through clear mandates, technocratic, predictable, legally defined. This time, the instruction comes straight from the president, through a social media post directed at unnamed representatives. Within hours, the head of the Federal Housing Finance Agency stepped forward and said his agency was on it. The signal was clear. This was not theoretical. But markets do not move on intention alone. They move on credibility, legality, and expectations. Who is authorized? Under what authority? For how long? Those questions matter because mortgage bonds price in trust. Trust in institutions, trust in rules. Trust that today's intervention will not become tomorrow's distortion. The moment that trust wavers, rates do not fall, they rise. So the mini crisis is not about buying bonds. It is about blurring the line between political command and financial architecture. And once that line is blurred, the consequences do not stay contained. They spread. What sits beneath this moment is a mechanism most people never see, but it governs everything. Mortgage rates are not set by decree. They are formed by expectations about inflation, about risk, about how permanent an intervention really is. When a trusted buyer enters the market, prices rise and yields fall. That is how mortgage rates come down. But only if investors believe the buyer is stable, independent, and constrained by rules. That is why the Federal Reserve matters. It is insulated, it moves slowly, it signals clearly. A politically directed buyer sends a different message. It suggests urgency, possibly pressure, possibly impermanence. Investors ask new questions. Will this continue if markets react badly? Will Congress intervene? Will a future administration reverse course? Uncertainty widens, spreads. Wider spreads push mortgage rates up, not down. At the same time, buying mortgage bonds does nothing to fix supply. It does not add homes. It does not free inventory. It only pulls demand forward. So the hidden mechanism is this. You can lower rates on paper and still make housing less affordable in reality. Because when money gets cheaper in a market with too few homes, prices rise faster than payments fall. And that sets up the second collision. The second collision comes when theory meets lived reality. Because housing is not a spreadsheet. It is where people live. When rates fall, buyers rush back in. First-time buyers. Investors, anyone who has been waiting on the sidelines, but the homes are not there. Millions of families are still holding on to ultra-low pandemic mortgages. They cannot afford to move, so they do not. That means more competition for fewer listings, bidding wars return, prices climb, and for many households, lower rates do not feel like relief. They feel like another door closing. If you are a renter, you face higher prices. If you are a buyer, you face sharper competition. If you already own, your home rises in value, but mobility disappears. This is the paradox. A policy meant to ease pressure can intensify it. And when people realize that frustration turns political, because expectations were raised, promises were made, housing is emotional, it is the American dream made concrete. And when that dream feels manipulated, trust erodes quickly. That is why this moment matters far beyond interest rates, because it reshapes how ordinary Americans experience power. Now place yourself inside this moment, not as a policymaker, not as an investor, but as a family trying to buy a home. You watch the announcement. You hear the promise. Lower rates, lower payments, relief, and for a brief moment, you hope. Then reality sets in. Listings are still scarce. Prices are still high. Competition is still brutal. If you are renting, you wait longer. Saving becomes harder. Every month feels like falling behind. If you are trying to buy your first home, you feel whiplash. Lower rates pull more buyers in. Cash offers return. The ladder moves higher just as you reach for it. And if you already own a home, you are stuck. Your mortgage is cheap, but moving would mean doubling your rate. So you stay put. This is what policy feels like on the ground, not abstract. Personnel. If you have ever felt housing slipping out of reach, you are not alone. And if this story matters to you, stay with me. Because what happens next does not stop at America's borders. Housing is often treated as a domestic issue, but it never stays that way. When the United States intervenes heavily in mortgage markets, global capital reacts. Mortgage bonds are held by investors around the world pension funds, sovereign funds, banks. A sudden politically driven buyer changes risk calculations, capital rebalances, money flows shift. If investors demand higher yields to compensate for uncertainty, borrowing costs rise elsewhere, not just for homes, for governments, for companies. For consumers, there is also a signal effect. When the world's largest economy leans on housing finance to solve social pressure, others take note. The line between fiscal policy and financial markets blurs. And then there is the institutional question. The Federal Reserve has spent decades defending its independence. Markets believe in that independence. A parallel channel driven by executive direction complicates that belief. Even if intentions are good, the precedent matters. Because once politics enters pricing, it rarely exits cleanly. So what began as a housing intervention starts to ripple outward. Through markets, through expectations, through trust, and those ripples shape the future. Which brings us to the hardest question of all. The future now branches into three paths, and none of them are simple. The first path is the optimistic one. The bond purchases are executed cleanly, markets accept the buyer as credible. Mortgage rates ease modestly. Housing activity stabilizes without reigniting price surges. Relief arrives slowly, unevenly, but real. The second path is more likely. Rates dip briefly, then uncertainty creeps back in. Legal questions surface. Political pressure intensifies. Markets adjust upward. The intervention becomes noise rather than cure. Housing remains expensive. Supply stays constrained. Frustration lingers. The third path is the dangerous one. Confidence breaks. Investors demand higher risk premiums. Mortgage rates rise despite the purchases. Political control over finance becomes normalized. In that world, short-term fixes replace structural reform, and trust, once lost, is hard to rebuild. This moment is not just about homes. It is about how power moves through systems, whether we respect their limits or pretend they do not exist. Because the hardest problems cannot be solved by will alone. They demand patience, institutions, and choices that last beyond a single post. So let us be honest about what this moment really is. It is not a magic lever. It is not a shortcut back to affordable housing. And it is not the end of the story. It is a signal that pressure has reached the top, that housing has become too central, too painful, too political to ignore. Trump's order reflects a deeper truth. Americans are not just angry about prices. They are angry about feeling trapped inside systems they cannot influence. But here is the lesson history keeps teaching us. Markets can be guided, they can be supported, but they cannot be commanded for long. Affordable housing will not come from one post, one purchase, or one institution. It comes from supply, from trust, from policies that work with the system, not against it. The real question is not whether this move lowers rates next month. It is whether America is willing to confront the harder, slower fixes that actually last. Because housing is not just about money. It is about stability, mobility, and dignity. If you want to understand where this story goes next, and what choices still lie ahead, stay with me. This is not the end. It is the opening chapter of a much larger reckoning.